A retired postal worker in Pennsylvania named Walter sat at his kitchen table in March of 2026, staring at a Roth conversion confirmation he had signed 3 months earlier. He was 68 years old. His wife Eleanor was 66. Their combined pension and Social Security income ran about $128,000 a year. And in December, their financial advisor had told them to convert $90,000 from Walter's traditional individual retirement account into a Roth. Smart move, the advisor said. Lock in today's tax rates. Pay the tax now, never again. What the advisor never mentioned, never calculated, never warned them about was that the conversion pushed their modified adjusted gross income to $218,000. And that number crossed a threshold that most tax preparers in this country have not even put into their software yet. Walter and Eleanor lost the entire new senior bonus deduction. $12,000 of deduction gone. At their marginal rate, that was roughly $2,640 of real tax, vaporized, because no one explained the interaction. And the mistake Walter made, with the best intentions in the world, signing a conversion ticket in good faith, is the exact same mistake tens of thousands of retirees are making right now between now and the end of tax year 2028. Here is what happened to them. Here is why almost nobody is talking about it. And here is exactly how you make sure you capture every dollar of this deduction before it disappears forever on December 31st, 2028. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the law itself, because the language around this deduction has been sloppy even in the financial press. On July 4th, 2025, the One Big Beautiful Bill Act was signed into law. Among the dozens of provisions inside that bill was a brand new temporary deduction, sometimes called the senior bonus deduction, sometimes called the bonus standard deduction for seniors, sometimes called the OBBBA senior deduction. Whatever you call it, here is what it actually does. If you are age 65 or older by the end of the tax year, you get an additional $6,000 deduction on your federal return. If you are married filing jointly and both spouses are 65 or older, you each get $6,000 for a total of $12,000. And here is the piece that most people miss in the first reading. You get this deduction whether you take the standard deduction or whether you itemize. It is on top of the regular standard deduction. It is on top of the extra standard deduction that seniors have always received. It does not replace either one. It stacks. Let me put real numbers on it so you can see the picture. For tax year 2026, a married couple, both over 65, takes the base standard deduction, which is roughly $32,200, plus the existing extra senior standard deduction of around $1,600 per spouse, plus the new $6,000 bonus per spouse. Their total standard deduction climbs to approximately $47,400. For a single filer who is 65 or older, the numbers are roughly $16,100 plus $2,000 plus $6,000, landing around $24,100. That is real money. That is the kind of money that turns a $4,000 tax bill into a zero tax bill for a lot of modest income retirees. But here is where it gets critical, and this is where people like Walter and Eleanor are getting hit. The deduction phases out based on modified adjusted gross income. For a single filer, the phase-out begins at $75,000, and the deduction is completely gone at $175,000. For a married couple filing jointly, the phase-out begins at $150,000, and the deduction is completely gone at $250,000. The phase-out is 6% of the amount over the threshold, which means every extra dollar of income in the phase-out band costs you 6 cents of deduction. If you are a couple at $200,000 of modified AGI, you have already lost $3,000 of your $12,000 deduction. If you are at $230,000, you have lost $4,800. And if you cross $250,000 by even $1, the entire $12,000 vanishes. The Internal Revenue Service is not going to call you to explain that. Your tax preparer may or may not catch it, depending on what software they use and whether they are actually running planning projections. Your financial advisor, the one who recommended that Roth conversion, almost certainly did not model it. And now for the part that makes this urgent. This deduction sunsets after tax year 2028. Under current law as it stands today, tax year 2028 is the last year you can claim it. For tax year 2029, it is gone. That gives you 3 full tax years, 2026, 2027, and 2028, to plan around it and capture every dollar. 3 years. That is the planning window. After that, unless Congress extends the law, the deduction disappears completely. Let me walk you through 3 scenarios so you can see exactly how this plays out in real life. Scenario 1. A retired couple in Arizona, both 67 years old. He was a municipal engineer, she was a dental hygienist. Their combined Social Security is $54,000 a year, his pension is $32,000. She takes $10,000 in required minimum distributions from a small traditional individual retirement account. Their modified adjusted gross income, roughly, sits at about $96,000. That is well under the $150,000 phase-out threshold. They take the standard deduction, which for them, in 2026, works out to about $47,400 after all 3 layers stack. Their taxable income drops to roughly $48,600. They owe, on that, approximately $3,200 in federal tax. Without the new bonus deduction, their taxable income would have been $60,600, and their tax would have been closer to $4,700. So the bonus deduction saves them roughly $1,500 a year. Over 3 years, 2026 through 2028, that is $4,500 in their pocket. Real money. Unremarkable savings. Smooth. This is the deduction working exactly the way it was designed to work for ordinary middle-income retirees. Scenario 2. Margaret, a 69-year-old widow in North Carolina. Her husband passed away in 2024. She is a single filer now. She collects a survivor Social Security benefit of $32,000 a year. She takes $12,000 a year from her late husband's individual retirement account. She has a small annuity paying her $4,000 a year. Her modified adjusted gross income sits around $36,000. She is nowhere near the $75,000 phase-out for singles. For tax year 2026, she gets the base standard deduction of roughly $16,100, the existing extra senior standard deduction of around $2,000, and the new $6,000 senior bonus. Her total deductions land near $24,100. That is almost 2/3 of her gross income, wiped off the board before she calculates $1 of tax. Her federal tax bill in 2026 is effectively zero. Margaret had no idea this deduction existed. Her tax preparer, a storefront chain operation, ran her return using the same software they used last year and charged her $185. She almost did not come in at all this year because she thought, quote, nothing really changes. $9,200 of new deduction landed in her return, moved her from a small refund into a much bigger refund, and she found out about it by accident when her neighbor mentioned it. Nobody called her, nobody wrote her. The Social Security Administration did not send her a letter. The Internal Revenue Service did not alert her. Scenario 3, and this is the one that matters most. This is Walter and Eleanor, the couple from the opening. Their situation is what I call the phase-out accident. Their baseline modified adjusted gross income before any conversion would have run about $128,000 a year, comfortably under the $150,000 phase-out threshold, comfortably inside the full $12,000 bonus deduction. Doing nothing, they capture the full $12,000 and save roughly $2,640 a year in federal tax. Over 3 years, that is approximately $7,900. Instead, in December of 2025, their advisor recommended a $90,000 Roth conversion in tax year 2026. The conversion added $90,000 to their modified AGI, pushing them to $218,000. That is $68,000 over the $150,000 phase-out threshold. 6% of $68,000 is $4,080. That is how much of their $12,000 bonus deduction was erased. On top of that, the conversion itself created a federal tax bill of roughly $19,800 at their marginal rate. On top of that, it pushed their Medicare premiums into a higher income-related monthly adjustment amount bracket 2 years later, adding another roughly $2,300 in combined Medicare surcharges for 2028. Their advisor called it a smart tax move. The actual cost, when you add the lost bonus deduction, the conversion tax itself, and the downstream Medicare surcharge, was north of $26,000. Same couple, same account, one decision, made without modeling the interactions, cost them more than the value of the deduction they could have locked in by simply waiting or by spreading the conversion across multiple years to stay under the phase-out floor. Now here is the part that changes everything. The senior bonus deduction is the first new tax benefit in years that is specifically designed to reward ordinary middle-income retirees and punish, in effect, retirees who are pushing their income artificially high. What this means for you is that for the next 3 years, income timing matters more than it has mattered in a decade. Every dollar of income you can keep below the phase-out threshold is worth the marginal tax rate on that dollar plus the 6 cents of additional deduction you preserve. If you are a couple in the phase-out zone between $150,000 and $250,000, your effective marginal federal tax rate on each extra dollar of income is your statutory rate plus approximately 1.5 percentage points from the phase-out alone. If you are in the 22% bracket, your true marginal rate inside the phase-out zone is closer to 23.5%. If you are in the 24% bracket, you are paying closer to 25.5%. The phase-out is a hidden tax that most people, including most tax preparers running off last year's template, do not see. Here is where the trap closes for people who do not plan. Required minimum distributions from traditional retirement accounts are not optional. If you have a large traditional individual retirement account balance and you are already taking substantial distributions, you may already be sitting at or above the phase-out threshold without doing anything. In that case, the bonus deduction is partially or fully gone for you no matter what you do, which means any additional income, any Roth conversion, any realized capital gain, any part-time work income, any pension bump, is costing you both the statutory tax and the phase-out penalty. And here is the counterintuitive move that almost nobody is running. For retirees who are sitting just above the phase-out threshold, a qualified charitable distribution directly from a traditional individual retirement account up to $108,000 per person in 2026 reduces modified adjusted gross income without ever appearing on your return as taxable income. It can pull you back under the phase-out threshold and restore some or all of the bonus deduction, on top of the charitable benefit itself. Your tax software is not going to suggest it. Your advisor, if they are not running quarterly projections, is not going to catch it. But Internal Revenue Code Section 408 paren d paren 8, the Qualified Charitable Distribution Rule, has been on the books since 2006, and it interacts with this new deduction beautifully. Here is your action checklist. 1. Pull your 2025 tax return today and write down your modified adjusted gross income for that year. If it is anywhere between the phase-in threshold and roughly $20,000 above it, you are in the danger zone, and every income decision you make between now and the end of 2028 needs to be modeled against this deduction. 2. If you are a married couple, both age 65 or older, calculate what your projected modified AGI looks like for 2026, 2027, and 2028, assuming you do nothing. Compare it to the 150,000 floor and the 250,000 ceiling. 3. Before you execute any Roth conversion between now and the end of 2028, run the full stack projection. That means the conversion tax, the effect on your modified AGI, the phase-out penalty on the senior bonus deduction, and the income-related monthly adjustment amount surcharge on Medicare Part B and Part D 2 years out. A conversion that looks smart on its face can be a net negative once you add the 3 hidden costs. 4. If you are charitably inclined and you are at or near the phase-out, route your charitable giving through a qualified charitable distribution directly from your traditional individual retirement account rather than writing checks from your bank account. The qualified charitable distribution limit in 2026 is $108,000 per individual. It reduces your modified AGI dollar for dollar, which can rescue some or all of your bonus deduction. 5. If you are still working part-time or you are contemplating a consulting engagement, be aware that earned income counts toward modified AGI and can push you into or through the phase-out zone. A $5,000 consulting gig for a couple sitting at $148,000 of modified AGI can actually cost you more in lost deduction than the consulting paid. 6. Pull Internal Revenue Service Publication 501 and Publication 554, which cover standard deductions and tax guide for seniors, and read the 2026 updates directly from the source rather than from a summary. 7. If your tax preparer did not mention the new senior bonus deduction on your 2025 return or in your 2026 planning conversation, that is a warning sign. Ask them directly how they are modeling the phase-out. If they cannot answer clearly, consider getting a second opinion before December 31st of the current tax year. 8. Mark December 31st, 2028 on your calendar today as the hard deadline for this planning window. Under current law, that is the last day this deduction exists. 9. If you have a large traditional individual retirement account balance and you are under age 73, so required minimum distributions have not yet started, seriously consider spreading any Roth conversion activity across the 2026 through 2028 window in amounts small enough to keep your modified AGI below the 150,000 threshold each year. 10. If you are a widow or widower in your first full year as a single filer after your spouse's death, your phase-out threshold dropped from 150,000 to 75,000 overnight. That is a 50% cut in your phase-out floor. Your income picture did not change, but your tax picture did. Run the numbers immediately because the widow's penalty is real, and this deduction compounds it if you are not careful. Let me recap the stakes in plain numbers one more time. A married couple, both over 65, under the phase-out, claiming the full $12,000 senior bonus deduction in each of the next 3 tax years, captures roughly $7,900 of cumulative federal tax savings. A widow in her late 60s with modest income captures roughly $4,500 over the same 3 years. A couple that stumbles into the phase-out through a poorly timed Roth conversion or a lump sum income event can lose the entire $12,000 and simultaneously trigger $20,000+ in other cascading costs. Same couple, same accounts, same income profile. One decision made with the calendar in mind and the thresholds respected captures every dollar. The other decision, made without running the full projection, loses everything and then some. This is not a loophole. This is the One Big Beautiful Bill Act, signed into law on July 4th, 2025, and it has a hard expiration date of December 31st, 2028. After that, under current law, this window is closed. This is how people die broke, not from a market crash, from a signature on a conversion ticket in December that nobody modeled against a deduction that nobody explained. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who is 65 or older, especially one who is considering a Roth conversion or a major income event between now and 2028, send them this video today. It could be worth thousands of dollars to their family. And in the comments below, answer me this. Did your tax preparer mention the new senior bonus deduction to you this year? Yes or no? I read every single one, and the most common questions become future videos. I will see you in the next.